Let's start with the chart because, honestly, the technical story is genuinely concerning. Hbar recently tested the 9-cent level from above. That should have been support. Instead it broke through and, well, opened the door to further downside. The rally attempt off that level just failed to sustain. Sellers came in, momentum stalled, price pulled back. This is classic failed breakout behavior. The market tried to establish higher lows, but it just couldn't. Now the risk is that the entire support structure breaks down. Currently, Hbar is trading around 10.2 cents, which is just slightly above the resistance zone that slowed its momentum. That resistance is right near 11 to 12 cents. For the bullish case to work, buyers really need to break through this zone decisively. If they do, the next target would be around 15 cents, where Hbar previously consolidated during earlier rallies. But here's where the risk lives. If Hbar can't hold 9 to 10 cents, the downside is, well, pretty clear. The price could slide back to 8 cents, then towards 7 cents, where there is buying interest historically. But that's a 30% drop from current levels. So technically, Hbar is balanced on a knife's edge. Hold 9 to 10 cents and the upside toward 15 to 22 cents is theoretically open. Break below and the downside toward 7 to 8 cents becomes reality. The chart alone doesn't give you clear direction. That's where the fundamental story becomes critical. Away from the chart, a different narrative is developing. In Washington, crypto regulation discussions are slowly moving forward. This isn't hype. This is actual legislative work happening. The Clarity Act is the focal point. Multiple industry voices, including JP Morgan executives, believe there's a strong probability this bill becomes law by mid-2026. That's less than a year away. So, what does Clarity actually do? Well, it defines how digital assets are treated in United States markets. This has honestly been the missing piece for years. The regulatory fog has prevented institutional capital from flowing freely into crypto. Institutions want clarity. They want to know the rules before deploying serious money. The Clarity Act removes that uncertainty. It creates a framework. It says here's what crypto is in the eyes of the United States government. Here's how it's regulated. Here's what's allowed and what isn't. For assets like Hedera, this changes everything. Right now, institutional participation is held back by regulatory uncertainty. Just imagine what happens when that fog clears. Pension funds, insurance companies, corporate treasuries, all the capital that's been waiting on the sidelines suddenly becomes available. Of course, this isn't guaranteed. Bills can stall, politics can shift. But the fact that serious players are discussing mid-2026 as a realistic timeline shows real momentum. Now here's where analyst B. Mendo highlights something potentially massive. Kraken just became the first crypto-native company to secure a Federal Reserve master account. That might sound a bit technical, but the implications could really reshape how crypto integrates with traditional finance. A Fed master account gives Kraken limited direct access to the Federal Reserve's payment system. That's basically the backbone of how money moves in America. Banks use Fed rails for settlements. For crypto companies to access that infrastructure directly, that's honestly unprecedented. So, what does this actually enable? Well, for starters, it means faster fiat payments and direct settlement through central bank infrastructure. We're talking about real-time connections between crypto and traditional banking systems. But honestly, this isn't just about Kraken. It's about creating a model. If Kraken can pull this off successfully, other platforms could follow suit. You could end up with crypto infrastructure directly integrated into the Fed's payment system. And here's where B. Mendo's argument really matters. If crypto platforms can directly connect to traditional banking, which networks are going to benefit the most? The answer is real-world utility networks, assets that are designed for actual economic activity, payments, stablecoins, supply chain settlement, real-world tokens, not just pure speculation tokens. We're talking about real infrastructure here, and that's exactly where Hedera comes in. Now, here's where analyst B. Mendo highlights something potentially massive. Kraken just became the first crypto-native company to secure a Federal Reserve master account. That might sound technical, but honestly, the implications could reshape how crypto integrates with traditional finance. A Fed master account gives Kraken limited direct access to the Federal Reserve's payment system, and that's basically the backbone of how money moves in America. Banks use Fed rails for settlements, and for crypto companies to access that infrastructure directly. That's just unprecedented. So, what does this actually enable? It means faster fiat payments, direct settlement through central bank infrastructure, and real-time connections between crypto and traditional banking systems. Again, it's not just about Kraken, it's about creating a model for everyone. If Kraken can do this successfully, other platforms could follow, and you could see crypto infrastructure directly integrated into the Fed's payment system. Bimendo's argument is really important here. If crypto platforms can directly connect to traditional banking, which networks stand to benefit the most? The answer is real-world utility networks. We're talking about assets designed for actual economic activity. Things like payments, stablecoins, supply chain, settlement, and real-world tokens. Not just pure speculation tokens. This is real infrastructure, and that's exactly where Hedera comes in. Hedera occupies a unique position that makes it particularly suited to benefit from crypto and traditional finance integration. The network is run by a council of global companies, not anonymous miners. It has enterprise governance built in. The use cases are real-world focused. Media group digital payment transaction on screen. Supply chain logistics with shipping containers. Business person using stablecoin payment app or stock distribute equally. Payments, stablecoins, supply chains, and real-world tokens. These are the types of applications that traditional finance needs to integrate with blockchain infrastructure. Bimendo's argument is that if traditional finance and blockchain infrastructure begin merging more closely through models like Kraken's Fed Master Account, Hedera's structure puts it in a strong position. Why? Because enterprises want governance they can understand. They want council-based decision-making with recognizable companies. They want networks designed for compliance and real-world utility. Hedera has all of that. Compare that to anonymous proof-of-work networks. Traditional finance isn't going to integrate with anonymous mining operations, but they might integrate with enterprise-governed networks built by and for real economic activity. That's Hedera's edge. That's why Bimendo sees it as a potential beneficiary of crypto and traditional finance convergence. The timing matters too. Kraken's Fed account is happening right now. Clarity Act discussions are advancing right now. Regulatory clarity is coming mid-2026. These aren't theoretical future events. They're happening in real time. If you're understanding how technical weakness and fundamental strength can diverge, how a weak chart can be hiding a transformational catalyst underneath, you need to like this video right now. One click helps the algorithm reach traders who understand catalyst timing versus chart patterns. Plus, share this with other people watching Hedera. They need to understand both the technical risk and the regulatory tailwind. They need both pieces to make informed decisions. Let's talk about price targets because understanding what's possible helps contextualize the risk-reward. Technically, if Hbar breaks above the 11 to 12 cent resistance zone, the next target is 15 cents. That's where Hedera previously consolidated. Reaching that would be about a 45% move from the current 10.22 cents. But if the market environment improves and institutional money starts flowing into crypto more freely, which regulatory clarity would trigger, Hbar could work toward the 18 to 22 cent range. That's the next meaningful upside area on the chart. That's roughly double from current levels. Those aren't crazy predictions, they're just previous price levels where Hbar had consolidated. The chart is already showing the market knows these levels are important. But here's the critical requirement. Hbar needs to hold the 9 to 10 cent floor. That's acting as support. If that breaks, the narrative shifts from waiting for catalysts to, well, downtrend confirmed. The price could slide towards 7 to 8 cents. So, the setup is asymmetric. Hold support. Wait for catalysts, potentially double. Break support. Downtrend confirms. Potentially drop 30%. That's a binary outcome just waiting to resolve. The question becomes, which narrative wins? The technical weakness or the fundamental strength? This is the critical insight. Most traders are watching the chart and seeing weakness. They're taking that as a reason to sell, but they're missing the fundamental catalysts developing underneath. Most institutions are watching the regulatory environment and infrastructure developments. They're seeing potential for massive deployment, but they're waiting for the technical setup to confirm before allocating. So right now, Hbar is caught in a gap. Retail traders are seeing chart weakness. Institutions are waiting for chart confirmation before deploying capital. That's where the opportunity exists. If regulatory clarity accelerates, if institutional capital starts flowing, if Kraken's Fed model proves successful and spreads, Hbar's weak chart becomes irrelevant. The price catches up to the fundamentals. Fast. If regulatory clarity stalls, if institutions stay patient, if Kraken's Fed model doesn't spread, Hbar's weak chart becomes the dominant narrative. The price continues falling. Thank you for watching this divergence analysis. Hedera is sitting at exactly the kind of inflection point where understanding both technical weakness and fundamental strength is essential. The chart is telling you to sell. The regulations and infrastructure integration are telling you to hold and prepare for upside. Both are valid signals operating on different timescales. If you want to stay updated on Hbar's technical confirmation, the Clarity Act's legislative progress, Kraken's Fed master account implications, and when the fundamental catalysts actually start moving price, stay subscribed. We're tracking when divergences resolve. Check out the other videos on TJ Crypto World. We've got deep dives on regulatory catalysts, infrastructure integration, enterprise blockchain, and everything else you need to understand which narratives actually move prices. I appreciate you watching. I appreciate the analytical community. And I'll see you when the next divergence creates opportunity.